afternoon, everybody. Welcome to TraderMerlin show for your Thursday afternoon edition. Sorry, I'm transitioning over here to graphics and getting everything all set up. I guess I should have zoomed on in here. Looking a little weird today. Hope you all had a great session. Yeah, it was. I apologize. You're going to hear jackhammering in the background. As I told you, they were doing construction next door. Thought they were done, but now they're literally outside with a jackhammer. Probably 8 feet from my house, but if you go for the angle, I'm on the second story. The hypotenuse of that would make it, probably 12 to 14 feet away from me. Oh, it's quiet. Finally, I get to hear no jackhammering. All right, before I go insane, let's talk about the topic du jour. I've got a few different things we're going to discuss today. Number one is going to be more selling pressure. And again, I don't think this was a landslide negative pressure by any stretch of the imagination, but we did talk about I see Margaret asking in here, who talked about, we discussed what we needed to see in order to short this market. Well, you need to see it break pivot lows and make new lows, at least in the shorter term. And I'll start here with the S&P 500, which you saw today actually did break down below that little line we had, which outlines the lows for about the past 2 weeks. So that's certainly one place you could have gone short. There's many different ones. And, you know, depending on your style, some traders will do where it breaks down below consolidation point, like I have here on the S&P, which is below 56.26. Some will say, hey, we have this shooting star kind of still intact that goes all the way back to Monday's session, and we would have been looking to short on the breakdown below that yesterday. Now, I did not. I did, and today as well. I've been so busy. I have to wait a week or two to make some pretty significant announcements to you guys, but I don't want to jump the gun. But I've been involved in all kinds of interesting things going on in my professional and personal life over the past couple days. So I've been pretty sidetracked. I have had a chance to watch markets, but nothing that I was following came to levels that I wanted to. So I was okay there. But again, what was that signal, Margaret? It was looking for things to start to reverse and break lows. Yesterday we had it pretty aggressively on the NASDAQ, which was a great trading day. Today, where would we look to stop and pivot on this one? Well, the obvious target for a bounce is going to be the prior area where it ripped out of. And today we came pretty damn close to it. You see that tail from today's session came right back down to 19,000, right around 19,728 on the NASDAQ 100 futures, and you got your little bounce there. Now, for me, the concern is this pullback just a small temporary pullback, which I believe it is, or do we see, for me, it's a pretty major one. We'll see, Lisa. I need the details are yet to be inked and finalized, but there might be some big changes coming here in the near future, and I guess I'm not sure exactly how it's all going to pan out, but that's the beauty of life. Sometimes things just get thrown at you, and you just got to deal with it and make the most of it. So that's where we're going. Stanislav, no, I'm not in New Jersey. Not in New Jersey. I'm certainly not over New Jersey, although I like parts of Jersey. Newark Airport, I must say, one of the worst airports. Next to, just from a rudeness perspective, Newark Airport might be the worst. LAX is just the worst, period. But no. And they're jackhammering dirt, which is the funny part. It's not concrete. They're literally jackhammering dirt next door. You lazy people, dig with a pickaxe. All right. So that selling pressure continued today, although it did mellow out. And, you know, for those of you who are looking for tomorrow's sessions for opportunities, if I had to choose one way or the other, I would say it's most likely going to move to the upside. So you had this aggressive sell-off this week. Yesterday, obviously, the big day. Today, we came down on the NASDAQ, kind of bottomed out right near these prior lows that were on June 24th and 25th. I would, if you wanted to trade this tomorrow, personally, I would, let's get rid of this line here, and I would look for a breakout of one of these two ranges. So that's a breakout between below 19,728 or a break above 20,162. Granted, it could just go sideways and stay in the middle of that range. So there we go. Thank you, Steve. I appreciate that. I still have to figure out exactly what's going to happen. So there's multiple variables coming at me, and I have to make some pretty big decisions. So we'll see, and I will definitely keep you guys abreast of what that looks like. So that's your NASDAQ. S&P is a little bit different. I just mapped this one out as well. It doesn't have the same picture as the NASDAQ. NASDAQ looked, in my opinion, stronger for that move to the upside. But the S&P really not giving me anything that I want to trade off of unless it got deeper into this yellow box zone that we've got drawn on the screen and been drawn there. Yep, Triple witching, which always creates weird moves. Last Friday on triple witching is always a weird one. I don't really have any plan or pattern for it. Depending on all the meetings and calls I have to take tomorrow, I'm hoping I can get some trading done tomorrow. We shall see. Let's go look at the Russell, which had the biggest beat down today. Russell down another, 1.77%. So you have this giant move to the upside, and all of a sudden we're getting some aggressive moves to the downside. Although, where is it going to go? I look at this chart right here, and I really don't have any clear sense as to where it's going to go, unless maybe I split it up in the hourly time frame. There's your hourly, and this is why I love looking at things on different time frames. Oh, thank you, Moon Dev. Not sure who Moon. You're new to the show. Welcome, my friend. Appreciate that. Always appreciate that. And if you are new, hit that subscribe button so we get grow that subscriber base. That's got not be one of my primary goals going forward. So where did we bounce on this Russell on this little pullback? Well, conveniently, where would you say would turn? Probably going to turn in an area where it has in the past and turned aggressively. And you see this tiny little area right here. It's going to be hard for me to stretch this out for you guys. Come on. Come on. And it's not going to let me grab that line. I'll just do it like this. Exactly where we bounced today. Now, the question would be for tomorrow, does this hold and do you get follow through on this bounce up on the Russell? So I would be looking at the NASDAQ and the Russell as a potentially bullish trade for tomorrow. Remember, we still do have a lot of big earnings names coming out, so any of that could definitely cause some impacts on it. But if you didn't look at this on the hourly time frame, you wouldn't have seen that little spot right there, which I think is a pretty important one. What else did we have on that? That's broad indexes. I thought this was the interesting one for the day. Yesterday we had that dollar index breaking down below that demand zone that I'd drawn and been there for weeks, if not months. It looked like a bear trap because today just erased all of it and came back up above that one. So anybody who was using that kind of going forward as a trend to the downside, man, they got whipped out today. I'd love to have David on to see how he was playing this and if that impacted him, because this was a pretty big sell-off yesterday and all of a sudden gained it right back today on that dollar index. Thank you. You don't have to do that, but it's all right. I appreciate the contributions, but you don't have to do that. Just enjoy the show and send in your questions along the way. So we've got our major indexes, S&P, NASDAQ, Russell. We could check out the Dow if you guys want, because some people like that Dow. Dow is looking pretty darn good. I would say it's the best of our major four indexes right now, which shocks me because the Dow, in my opinion, is not really a good measure, right? You only have 30 stocks in there, and it doesn't really represent the whole market. Margaret says a break above the shooting star would be bullish. Yes, a break above any of these previous little highs would be bullish, of course, which leads me to the next question, and I'll talk more about broader markets here in a second, but this question came in from Brad. He said, could you rate the shooting star on the IOIR chart? How would you trade it? All right, well, that leads me to housing markets. All right, so let's talk about housing markets real quick. It's tough because there's two things I need to discuss at the same time, and they kind of overlap on each other. So maybe I can use my second graphic or third graphic and talk about former President Trump. So I don't know if you guys saw his comments today. He was being interviewed, and they asked him about what's your thoughts on the Fed cutting rates as you get near the tail end of the year. And of course, you know what Trump's going to say, because he needs to say this. They shouldn't do it. They don't know what they're doing. It'd be the wrong choice to cut rates. Obviously, because if you cut rates now, that would most likely make the Democratic candidate look better, because you get the markets rallying going into that election. That said, it brings up that question of what about rate cuts? If rate cuts happen, that doesn't necessarily mean that the long end of the yield curve is going to change. Rate cuts will impact that short end of the yield curve and bring down that current rate even lower. We'll bring that chart up here in just a second. Big ad. Netflix? Yeah, we'll get with Netflix. So Netflix, they increased their subscriber base more than expected, but they lowered their forecast going forward. Of course, just dropping the hurdle, if you will, and I'll get to that here in just a second. We can talk about that one. It was down. Last time I looked at it, it was down about 8%, but then it bounced back up. So let's talk about IOIR and real estate. If we do get rate cuts in September, it could be beneficial to the real estate market, because in theory what we would see is that entire yield curve. And let me see if I can bring up the entire animated yield curve for you guys. I wish I had TJ here to do this one for me, but there is an animated yield curve at stockcharts.com, which I think is fantastic. And here it is. All right, so that's your yield curve as of today. And for those of you who might be new to the yield curve, what it shows you here on the left-hand side is the different maturities. You can see 3-month, 2-year, 5-year, 7, 10, 20, and 30-year. Right now, we're starting to see the longer end of the yield curve somewhat normalize. It's kind of getting higher and higher as you go. It's the short end that's the problem, right? I'll check that in just a sec. You know, our short end is the one that's really stuck up here at the high price. Now, you can see even if we dropped it to 4.6%, this yield curve would still be inverted from the 3-month. Now, most yield curve analysis is done off the 2 and the 10, which would be where my cursor is right now, and unfortunately I can't draw the second dot, but it's slightly inverted right now. If this short end gets dropped, and we can go out here to our FOMC countdown page and see what the potential hypothesis is for the September meeting. Here's your September meeting announcement, which is when I do believe they will do the rate cut. It's a 91% chance that they're going to cut right now, and they're going to drop it from 5.5 to 5.25. So 25 basis point drop. Okay. Let's go and look back at IOR. So if we get that, yield curve. If we get that rate cut, this left side of this chart will drop a little bit. Now, does that mean that the long end will start to move up? I don't believe that necessarily to be the case. It may actually be coming down. And the reason for that would be if the short end starts to drop, and there's people in here like Big Eb, who I know, I got it. Big Eb was buying short-term bonds because the yield is just so dang good for 3 months, right? You get 5+% for the 3-month, great. But now that rate's going to be dropping, and those people looking to lock in longer yield or longer-term yields, they'll see the writing on the wall that short end is most likely going to continue to drop down lower, and therefore they may go and try to lock in longer-term bonds. What would happen if more people started to buy that 10-year? If more participants came into the marketplace to buy this 10-year, that yield might drop as well, because now the Fed doesn't have to, or the Treasury doesn't have to issue that high of a yield. If demand is that high, they'll go to the bond auction. If demand is much higher, then they can say, well, it was 5.25, now we'll give you 5 or 4.5 or whatever the demand may push that price down to. So that could be good for real estate. Now, to go back to Brad's question, which was about IYR, look, I'm a pattern person. And if you look at this IYR chart, yeah, how would I rate this shooting star? First off, what are some of the criteria that I'm going to look for when it comes to rating a shooting star? Well, first off, I already said first off. Said it 3 times already. I'm looking for something that's in a nice uptrend. IYR, I think, would qualify for an uptrend only over the last couple of weeks. If we look at the last few months of it, it's really choppy and predominantly sideways, even slightly down. So if you look at the shooting star on a scale of 1 to 10, 1 being it's not even a shooting star, it's garbage, move away, and 10 being this is the holy of holy shooting stars I've ever seen, I'm going to start to give you the criteria. Number 1, it's on this nice uptrend for about the past week. You have a very long topping tail, which shows emotion, and all of a sudden the sellers came back in and crushed IYR down to the low of the day. That right there by itself is a strong qualifying piece. So based off of those, I'd give this I would say a 6, maybe a 7. Now, what would make it a higher score is if this shooting star, today's candle on IYR, was higher up, like near the top of yesterday's candle. That would make it better for me. The other piece that I look at, which some people think is irrelevant, is volume. Ideally, if I felt this was going to be a reversal candle and see IYR come shooting down tomorrow or the next couple days, I'd want volume to be significantly higher than normal. And we don't have that. We have it a little higher, just slightly higher than average. You know, if I put my cursor on here, it actually feels like we're right around average. Yeah, just slightly, ever so slightly above the average daily volume for IYR. So I might give this like a 6.5 or a 7. I wouldn't call it a great shooting star. Yeah, for me, Oliver, volume is important, and we don't have the panic. Remember, part of looking for hammers and shooting stars is watching for panic and euphoria. When something goes sideways, you know, there's no real emotion. It's just kind of calm and there's not a lot going on. But when we get those extremes, like we saw that move up on the Russell over the past week, I mean, that's an extreme move. There's emotion there. And how do we know that? Well, just go to IWM. The volume during this move, look at it. You've had 1, 2, 3, 4, 5, 6 volume bars. And those 6, the last time we saw a bar anywhere even close to that is back in April of this year. And that's 1 bar. So yeah, we definitely feel the emotion here. What I like to see personally is what's called climactic volume. Excellent, Big Eb. Have a great day. I'd like to see climactic volume. Climactic volume is where you look at the average and there's a candle that's like 5 to 10 times normal. Now, and you can also see on IWM, we had this shooting star right here and mentioned that if we get it open up above that and then it moves below. So you could have actually had a pretty nice short on the Russell today too, based off this shooting star, which would have also been right around a 7 on the rating scale, at least my rating scale. Not that I'm the best at it. So let's go back to IYR. Personally, I think that the rate cuts are going to be good for real estate. But this isn't something that impacts snap of the fingers immediately, right? When you have rate cuts, it takes some time for that yield curve to adjust and adapt. Most likely that 10-year will drop in yield. So Big Eb is gloating over there because he's got a bet with me that we're not going to be below, or he bets we'll be below 4%. It could happen, all right? What did the yield do today? Well, let's go look at that 10-year right here. There was actually a move up. Yeah, please, Steve. Too soon for the shot jokes. Don't get shot, my friend. We don't need anybody getting shot. That was a too soon of a humor one on that one. But you look at that 10-year, you would have thought that based off some of these comments, particularly with Trump making the statement that, oh, well, they shouldn't be cutting rates, that would have actually have increased the 10-year, and I believe it did. I believe we saw that 10-year yield because if the talk track is don't cut rates, then the yield should rise. What's more likely to happen is Trump can say all he wants, and I'm sure he has plenty of advisors. Margaret says, who's advising Trump on economics now? I don't know. And let's go look at, I was going to go rate cuts. If you look at this, there's a 91% chance. I am in this camp, as I mentioned. I think September is going to be your 1 rate cut, and then I think they're going to hold and they're going to wait a couple of, at least 1 meeting before they start raising again. So you look at the end of the year forecast. Right now, there's a 50% chance of 3 rate cuts. I don't believe that to be the case. I think it will be 1, maybe 2. I maybe 2 by the end of the year, but I still am sticking in that 1 camp. I think that the prudent thing for the Fed to do is cut once. Again, I'm with Trump. I believe they shouldn't cut right now, but it probably will for the election. They shouldn't cut. They should just keep waiting because, again, things are looking pretty good. Now, we did have some somewhat negative data. Let me go out here today to our economic calendar, and I'll bring up the initial claims numbers, which I normally don't look at initial claims because it's every week and it's not that big of a deal. But let's just look at the chart here. Notice there is a trend going on with initial claims yields. And it may not seem like it's that dramatic, especially when you look back here into 2020. Look how high your unemployment or your initial claims were. I mean, thousands, you had 6 million initial claims happen in a very short window of time. But let's zoom in from 2022 on. The level that we're at, 243,000 initial claims, is not really that bad. But what we are looking is we are seeing an increase. It's getting higher and higher and higher. And there is a fairly clear trend from the beginning of this year with regards to initial claims. So that is a little concerning, but I don't think it's anything that's going to sway the Fed's decision. And remember, Fed's mandate is full employment and stable prices. So they're still going to be fighting that inflationary battle. And to me, keeping rates higher longer is better for that. Unless we see these unemployment numbers really spiked. It's I don't know if I would call that spiking, Oliver. I would say it's definitely trending higher. Spiking would be where you have, from one to the next is a giant difference. Now, this is only week over week, right? So you look at these numbers here. Yeah, it was a jump up from the previous one, but it's not huge. Now, if we went from, let's say, 240 up to, like, say, 350 or something, like, oh, wow, that's significant. But we're not getting that. And, again, I like to always reference time in this one. If you look at the chart here, I don't think there's anything to worry about with initial claims at 240,000. Now, let's go back pre-COVID if I can. All right, here's pre-COVID. Let's go right to there. And now we're here at 243. Well, look all the way back into 2016, 17, 18, 19. We were way higher than that. And that was a market that was really moving to the upside, right? So, hearing everybody freak out about this, it's the highest level of unemployment we've seen in, a year. So what? I don't really think anything under 250, maybe even 300 is that big of a deal. I'll keep my cursor right here on 250, and you guys can see that since 2022, we've gone above that multiple times. But granted, we're below it most of the time, but not that big a deal. If we go back into even older stuff before COVID hit, I'll put it on 250, and you can see we were also below that most of it, but there's a large period of time where we were above it. So I don't think that this is that big of a deal. I think this is no big deal, so don't let the media fool you on this one. I don't think the Fed's going to cut rates to help the unemployment numbers. It's just not there yet. We've looked at the unemployment numbers. Let's bring that one back up here. It's going to take me a second. Was it last weekend? I always forget. It's always on a Friday. So let me click on here. Nope, it was the 5th. So here's your July 5th unemployment rate. Let's do that same analysis because initial claims is very kind of temperamental. I think you'd all agree that we are seeing an increase here in the unemployment data. But this isn't like jaw-dropping panic type stuff. It's just a slow increase. And remember, we were at a level that is historically low. I'll go here back before COVID hit. This is before COVID hit. We being down below 4.5 is what the Fed said was full employment. That's a great place to be. Let's see how far back I can go. Here we go. Let's go before the financial market crash. We were well above 5%. So it's very rare, it appears to me, that we are significantly lower than 4.5. Therefore, again, I don't think the unemployment number should be that worried about a 4.1. So the Fed should keep rates where they're at. If I was the chairman, I would keep it right where it's at because, again, I would not be swayed by a president or any political figure to do what's right for them. It's right for what's the economy. And at this point, no need to juice it. Let's let this economy heal at higher rates. If we drop it back down to lower rate environment, you're stimulating it when it doesn't need to be stimulated. Anyway, a lot of time in seasonal. Yep. Tom says, speaking of macroeconomics, our boy Navarro finished his Banana Republic sentence yesterday morning and spoke at. Oh, did he? Man, it's shocking to me that I actually got to work with Peter Navarro. I taught with him. I taught for his MBA program, and it's just kind of a strange thing. I already told you. He pirated my stories. If you want to read my stories, which should be in my book, but apparently they made it in his book. It's If It's Raining in Brazil by Starbucks, something like that. I think that was the name of it. It drives me absolutely crazy. Steve Wolf says, 5% of the people didn't want a job anyway, in my opinion. Totally agree. I had a good friend of mine who said, I'd rather just collect unemployment and take under-the-table jobs. I'll sit around and do nothing. How do you live with yourself there? You got to work, man. Got to earn your keep. All right. Man, we went off on some real tangents on that one. Let me go back to our initial discussion. So, again, rate cuts. Rate cuts are probably going to happen. I do think you're going to see them. That's why I have this chart right here, or this picture right here. I love AI. He did Kramer me. Yep, took all my stories. He Kramered me. I said, show me the FOMC members with large knives in their hands for the rate cuts. I thought this one was pretty good. Although, I don't know who this is on the end on the left, but he's got two giant knives in one hand. Stud. All right? And not the best picture of Jerome Powell. All right, so we're probably going to get one rate cut. What's that going to do? Well, this yield curve will drop. This whole thing should come down. Not that it's going to save just the left side, but most likely what will happen is the right side will also drop a little bit, but that may take a little bit of time for that to happen. Again, we'll have to wait and see. But that's my belief on what's going to happen. Oops. That's my belief on what's going to happen with those rate cuts. They're coming. They're coming. One this year. I'm still sticking to it. You like that one, Jim? I thought that was pretty good, too. Okay, let me continue on. I think I had another question. This question has come up, so let's talk about Netflix. I know Big Ed was like, what is going on with Netflix? Well, let's take a peek at Netflix. And, of course, you guys let me know if there's anything else that you want to take a peek at, and I will gladly look at some charts here for if you want. Here is Netflix. So, again, Netflix beat estimates on subscriber base. Their earnings numbers, I can see it right here. They were supposed to come out at $4.71. They came out at $4.88. In the after hours, it's definitely been a wild ride. Here's your 5-minute chart, and let me show you. Oh, this does include after hours. So there you go. You had that initial surge down. I mean, this popcorn trade of the day. This is absolutely a popcorn trade. So right from where it closed, it went all the way down to, it was down 6.67%. So it dropped $42 per share, and then all of a sudden ripped to the upside, and now you're drifting higher. This is why, again, I don't like trading earnings. I went to lunch with a good friend of mine. You guys might know Mike McMahon. Always a pleasure seeing Mike. We used to work together at Trading Academy, and just awesome. Love Mike McMahon. And he was like, I love trading earnings. And I may see if I can get him on here to talk about trading earnings, because I don't particularly like to go into an announcement with a bias, because I look at Netflix personally. And here's my graphic for today. Remember, Midjourney can't do words. So I said, show me Netflix having, I think I said blowout earnings, and this is the picture I got. It looks like it broke through a bar of chocolate. It's kind of a cool background, but Netflix is clearly spelled wrong. I think it looks kind of cool like that. Anyway, Mike was like, I love trading earnings. We talked about performance, and he's having a pretty good year. And I said, what's your strategy? We always like to ask that. What are you looking at? How you acting? How you trading? And for him, it's earnings. He'll go into an earnings announcement. I was like, whoa, really? Because when I think Netflix, I think, number one, you got a tremendous amount of competition in the marketplace. Number two, you only have so many subscribers that you're going to get. Like, you can't go above and beyond the amount of people on the planet or people in a country, right? If I'm a parent, I'm not buying a Netflix account for my kid. They can, if they're at home, they're going to use at home. Now, when they switched over and now we're charging for different home licenses, like IP address type stuff, that certainly would have increased their subscriber base. But at some point, you're going to max out on your customers. You're going to max out on the amount that you're going to be able to get. And I think that's always been my negative part. So I would have gone into this with a negative bias just because of that in my head. Well, I would have been rewarded for about 5 minutes, and now all of a sudden I would be underwater here on Netflix. So I don't trade earnings just because you never know what on earth's going to happen. You want to see what some of the other earnings were for today. Let's check that calendar out. Netflix, again, beat by 3.8%. They expected 470, came out at 488. You had a couple of other beats today. Nokia beat earnings, but it's Nokia. Like, what are they even doing here? Does anybody even own Nokia? Did Nokia make phones? I don't know. I don't know what it is. I go, Dad, do you know this voice? He go, oh, great. Is he watching? Hey, Norm. Good to see you, Norm. Hope you guys are doing well up there. Intuitive Surgical is another one that we'll check a chart out here in just a second. You remember, I did an article for Bar Chart last year sometime talking about embracing the AI revolution. And one of the companies I profiled was Intuitive Surgical, because they are looking to go all robotic and maybe creating an AI doctor, which seems kind of crazy to me. Not a doctor, an AI surgeon. So let's look at ISRG. A robotic doctor seems kind of creepy to me. So ISRG, even though they had a pretty ugly day, they've erased those losses today with their earnings announcement. So you can see here, Intuitive Surgical for the past 4 days looking pretty ugly. I'll go from their peak on July 11th all the way down to where we bottomed out today, down 7.32%. And then you bring in the earnings calendar, and all of a sudden, they are right back up where they were. So they just erased all those losses over the past couple of days and went right back up in overhead supply. So you're up 6.51% for ISRG, and I'll tell you about some of the earnings coming up here in just a little bit for tomorrow's session. Let me get this back from I like the daily. When I show the after hours, it always throws me off. Actually, it doesn't throw me off. It just graphically, it looks kind of awkward. All right, let's see. What else we got? How was Mike? I always enjoyed his sessions with OTA. Yeah, me as well. You know, Mike, it's funny. Mike is one of those people, you either love him or you hate him. Some people just have a hard time with his... I'm not going to say bitter. He's just a very direct person. And in trading, honestly, I'd rather have a direct person teaching me as opposed to someone who's all wishy-washy and vague. So Mike's doing well. Living down here in Southern California, retired and enjoying. Sure, you'd like to be doing some educating, teaching stuff. We'll see how that goes going forward. Infinity says, arrive late and watch that 2x speed to catch up. Oh, man. I already talk fast, Infinity. You're going to have, like, a headache from that one. Now that you slow it down to normal speed, it makes you sound drunk. I'm definitely not drunk. No drinking for me today. I might have a glass tomorrow, but I'm going into a pretty busy weekend. Steve says, don't you think that Netflix is by far the best service? Prime is okay, as well as others, but That don't you think that all lower streaming companies will be eaten up in 2 or 3 big boys? I do, but what have you got? If we look at the streaming side of things, you've got Disney, Hulu, Paramount, blah blah blah, blah, Apple TV, but I don't know if I count Apple TV. I know a lot of you use Apple TV. I don't. And I do think they're the dominant one. But again, they've already been dominant for so long, and they've already got subscribers increasing, right? They're looking at increasing their subscriber base. That's their main goals, more and more subscribers. What'll probably happen, and they've already done this, is they raise their fees, right? They raise their fees here a little bit. So that will probably be the next step that happens. If subscriber base slows down, which I believe it will at some point, you're just going to reach max capacity, then they'll start raising their prices. But they lowered their expectations about next quarter, and that's why they sold off immediately, but the numbers are pretty darn good. Tom says, smart cord cutters can watch Netflix for a binge for 2 and switch to some other streaming service for football season and switch to something else later. People will figure out stream switching. Yep, and they'll make it much easier. Oliver brings up one, which is my personal favorite, and that's YouTube TV. I'm a sports fan, so I use YouTube TV for that. Of course, you guys know I'm a 49ers fan, and there's a lot of stuff that you can't get without buying, the NFL Sunday ticket. However, there are other ways around that. So I have YouTube TV. Unfortunately, I have most of these services. There's Paramount, and then there's also Paramount and Peacock is another one. I think that those smaller ones will get bought up and kind of merged together. We'll see if YouTube TV takes them over, but you're right, Tom. There's no sense paying all those different fees, subscriptions. So, yeah, get one. And I mean, personally, I'm trying to watch less and less TV, so I should cut a lot of those subscriptions that I have. Although Netflix I will probably keep because I like Netflix. It'll be one of the ones I keep. And then Amazon Prime I keep because I'm an Amazon Prime addict, as I think many of you are. Sometimes I think I keep Amazon Prime in business just with all my orders on a daily basis. It's crazy. What about those sticks like a Fire Stick? Well, that's Amazon. So you can get Amazon Fire Stick. There's software out there like Kodi, which you can get everything for free, but it's just such a pain in the tuchus to configure. If you guys ever want to see something interesting, go to your local state fair or county fair. And there's always an exhibit hall. And in that exhibit hall, there's people selling all kinds of crazy stuff. And there's always somebody selling a little plug-in HDMI device that will get you every channel you want for $100, right? If you just ask to, give a demo, you'll see a name of that. The one when I went was Kodi, K-O-D-I. And Kodi, you could get everything under the sun. You could get every sporting channel, every international channel, every movie on demand. You get everything. But then it was rather difficult because, once they get discovered, regulators are coming in and trying to shut those channels down. So it was always like, oh, this stream's dead, this stream's dead, this one's up, this one's up. Yep, Kodi. Kodi was the big one for a while. And, if you are a techie and you have the time, look, get something like Kodi. You can throw it on Amazon Fire Stick, use Kodi, and you can get access to infinite materials around the world. And that's what I loved about Kodi, is it allowed me to get access to Italian television. So if I wanted to brush up on my Italian or maybe my German, I could just say, hey, give me German TV or Italian TV, or I'm going to Japan. Hey, let's play some Japanese TV so I can understand and maybe learn that language a little bit better. Yep, Jim says, oh yeah, there was a guy who made millions selling that. Yeah, what's crazy for me is, in my mind, I think it's illegal. Yet these guys are at just about every fair selling it. And the OC fair starts here on Friday, tomorrow, so it's going to be a pretty busy fair weekend for me. I'll go and I'll give you a report. I'm pretty sure there'll be somebody selling that stick again, and maybe it's with a different brand or something, but Kodi was the big one for a while. I put an antenna on my hillside. I put LA broadcast from Mount Wilson into my Plex. There you go. Most rabbit ears, huh? Putting antennas out there. I do that for old video game systems like Nintendo. Now that I like. I like when you can buy like a little USB stick and it's got 500 different video games. I think I may have mentioned this, but one of my favorite things in Las Vegas, which I would encourage you all to do, is you should go to the Pinball Museum. It's on the Strip. It's on Las Vegas Boulevard near the end. It's just past the Mandalay Bay Convention Center on the opposite side of the street. You can't miss it. Giant wall that says pinball. They used to, at the old facility, they used to have it where, like, year by year, you could go down the aisle and see 1920s pinball, 1930s, 40s, 50s, and just kind of keep going. Now it's just a hodgepodge of, they're all over the place, but Great place to go, fun one, and lots of old video games in there. I played a little Donkey Kong and some Joust when I was there last time. Gotta love that type of stuff. All right, sorry, I'm going off on tangents. Let's see. Tom says I believe there are 8 or 9 straight rate increases during President Trump's time in office. The market still went up. Good energy policy, peace, and other good policies can overcome 25 basis points. Yep, no argument there. But at a certain point, that would change. So to your point, Tom, everything works until it doesn't. And if you look at the amount of rate increases, let's go here and bring up your rate increases. So bear with me as I find the date, because we are going to look at on the 31st is the next FOMC meeting. So I will click here and show you. All right, so here you have between 2022. So this was the Biden one. We could argue that this was the Trump one right here. You didn't have straight rate increases. You had 1, 2, 3, 4, 5, 6, 7. You had 8 overall, but they weren't consecutive. It was raise, pause, raise, pause, raise, raise, pause, pause, pause. So there was more stair-stepping up in this one. And that's a little bit easier to understand as far as slowing down a market. Because the Fed did the right thing in my mind. Raise rates and then just wait and see what happened. Okay, but wait, it's a 6-8 weeks, fine. And then slowly raise more and see what the impact is. This one was a little bit different. This was very awkward on how aggressive they were. Those back there was all 25 basis point increases as well. Here we had 25, and then we had 50, 50, 50, 50, 50, 50, 25, 25, 20. I mean, those are pretty significant jumps to really squash inflation, and now we're kind of this holding pattern. So it does seem that the logical move would be to cut rates based off of this. Andrea says cutting rates are going to work with a lag. Yep, absolutely. So, and that's why I think they'll cut here in September. So if we look at the next meeting, it'll be July. I think they'll stay where they're at. I think they'll cut in September, and then it'll be that kind of wait and see, right? Do we need to be aggressive and all of a sudden cut rates? No, I don't think so. Even if we had inflation drop to 2% and unemployment stay right where it's at, there would be no need to cut rates. Full employment and inflation is under control. Why do you need to mess with anything? You should just leave it. You should keep rates at 5.5%. If the market continues to perform well, if we have full employment, which my benchmark's gonna be 4.5%, and your inflation is at 2%, which it's drifting lower according to the last CPI and PPI. If all those things stay the same, you should keep your rates at 5.5% and then keep it there until you need to use it, right? Does it hurt the economy to have rates at 5.5%? I don't think it hurts. Obviously, we could juice the economy and really make things surge and go haywire if we cut rates all the way back down to 0, but we don't need to. You're going to create more problems for yourself down the road. So slow and steady. They should keep it right where it's at. Let's see. All right, what other questions you guys have? What are things I got through my stuff. So I want to talk about Netflix earnings, which we did that there. I wanted to talk about national debt. Okay, this is one, I'm a patriot. I love my country. I really do. But we have to do something about this. And it's got to be more than just talk rhetoric on a presidential campaign trail. We are nearing, let's see if I can show it to you here. We are nearing $35 trillion in debt. I mean, if you're $1 million in debt, you're probably going to have to file bankruptcy. But these are $35 trillion in debt. And the reason I bring this up is it's not getting any better. It's actually getting far worse. Here's a chart of that. And you can see going back into 1990, it's understandable that debt might be increasing. And that increased into 2000. 2000, it looks like we shifted gears. So we went from 1990 to 2000 was like first gear, slowly going. And then from 2000 to 2008, it looked like we hit second gear. Then it looked like we jumped straight to fifth gear. I mean, really rip into the upside here. So this trajectory that we're on is unsustainable. If we continue doing this, and this continues to move up at this rate, based off what I'm seeing here, we will be at like $50 trillion worth of debt in the next 5 or 6 years because it's accelerating the upside. That is an unsustainable number. We will not be able to service the debt on that. And again, that's down the road, years down the road. But the question is, how do we get out of it? There has to be some major changes here, and it's going to come in the form of pain, everyone. There's going to be cutbacks in certain services. There'll be things that have to be scaled back. Maybe reevaluate who's working at the government so we can get rid of some of those jobs and save money. At some point, I think there will be some pain, but right now, that national debt is a frightening number. 35 is such a massive round number. And keep in mind, when I look at this chart right here, if we go back into 2021, we were at 28 trillion. 22, we jumped to almost 31, so we almost $3 trillion in a year. And here we are just in the middle of 2023, and we've already increased 2.2 trillion. And we were on case to get like 4 trillion there. Ugh, crazy. Let's see. My mom says, Lisa G, if you participate in the fractional reserve banking system, you are in that statistic. Yeah, I don't know if she's necessarily in that statistic. She didn't cause it. It's the fact that we are just reckless with our spending. We have a very poor responsibility or accountability for our elected officials, I believe. There should be an accountability. And when we look at numbers like this, and you realize that per citizen, the debt per person, not just per taxpayer, but per citizen is $103,000 for every little child you see. The government has already amassed $103,000 in debt for that child. That is mind-boggling to me. I'm a person, as you guys know, who I'm very big on living within your means. So, if you have $1,000 in your bank account every month, then you shouldn't spend any more than $1,000. And our government says, oh, we've got $1,000 in our bank account. Anyone who go to a strip club and just throw money out the window? All right, we'll spend 20 grand. I mean, it's like, wait, no, you only have 1,000. You can't do that. Yeah, that's a problem. But who wants to do that? Because if you're the president that is going to cut jobs, government jobs, cut services and industry and spending, get rid of different departments that might be redundant, etc., then you're going to have a whole segment of the population that hates you and thinks you are a bad person because you are now taking away those jobs. It's a no-win situation, honestly. But that national debt, we might hit 34 trillion by early next week. 35 trillion by early next week. It's just going so fast. That sounds good. Let's go. Hey, I think this is the difference, though. This is why you watch this show, because you're different. You're not the average American. I think everyone here is saying, I've got a pretty good handle on my finances. I live within my means. I'm not stretched to the max where I'm living paycheck to paycheck. That's probably not you. However, there are a lot of people that are that way. And I think if those cuts come, those people are going to be hurting. So our job is to set ourselves up in a financial position that if those cuts come, whether you're in a government business or you might be impacted by one of those segments being cut, that it's not going to hurt you as bad, or you have other channels set up. All right. I'm rocking and rolling today. What other questions you guys got before I wrap up here? I'm going to go to your economic calendar and earnings. I'll wait for a couple questions to come in here, and then I'm gonna dive. Steve says, budget needs to be balanced, then drop 10% off every government program across the board, and then look for additional cuts. I'll tell you what, Steve, I'm with you, and I think a lot of people here would agree with that. However, you might become one of the most hated presidents from a lot of people because you're like, oh, they're killing America. No, you're actually making it better by getting rid of some of the stuff, redundancy and bad stuff. Reason I got most assets in IBIT. Yeah, Mark, don't buy the ETF. I mean, if you're going to buy an ETF, buy IBIT. Just go buy Bitcoin outright and move it to a ledger. Get it outright. Own it. Right? Own it. Remove it from supply. Okay. Let's go to your economic calendar and earnings calendar for tomorrow. Obviously, economic-wise, it's going to be rather quiet. Fridays typically are, as you know. Let's go to the 19th, opening day of the OC Fair. Woohoo! So nothing really big for the U.S. We have two more FOMC members speaking. Of course, that was kind of the highlight of the week. I think there were so many FOMC members speaking. You saw 3 today, right? You had Daly speaking, you had Bowman speaking, and Logan speaking. All of which, gave their some little thoughts on what they thought was going to happen with rates. And most of them seemed very optimistic about cutting rates this year. Whereas, of course, President Trump said, no, it should be a mistake. Don't do that. Don't do that. Other things of interest, we did see the ECB keep rates right where they're at. That was totally expected, so no big deal there. Where rate cuts coming Is it time to invest in BLV? Let's go BLV. So this is a tricky question. And again, for those who don't understand bonds, it's really, you got to make sure you understand this relationship. If rate cuts are coming, and it's a great question, Margaret. I don't know if it's necessarily BLV or TLT or SHY or JNK, but which bond fund to be in. If we do see rate cuts, like plural, then what that means is that the yields are going to go drop and the price of bonds are going to go up. So what you're looking at here with BLV is not a yield, this is the price. So if you believe, Margaret, that rates are going to get cut this year, then buying BLV could be an option. SHY is short term, right? It already feels like they're pricing that in, doesn't it? This is the 1 to 3 year treasury. You see over the past 2 weeks, it's been a pretty big rally. Why? Because the talk track has changed. There's a lot more optimism for a rate cut, or maybe even 3 for this year. So there's SHY. You could go into corporate junk bonds, right? High yield. They've also been surging. Why? Because the talk track is we're going to see rate cuts this year. You guys know my stance, so I won't repeat that one. But yeah, you might be chasing a little bit, right, Margaret? Because right now it's kind of cooked in. The market has priced in 3 rate cuts. So if you buy something like BLV or TLT, I mean TLT is the big daddy here. I don't. Let me see the liquidity on BLV. So there's TLT, 35 million shares traded. That's 20 year. Let's go to BLV. Yeah, BLV has like very little volume. You're talking 400,000 looks like average. So personally, I'd probably go TLT just because of the liquidity. It's much greater liquidity. Yeah, I think that this is already priced in. So if we don't get those rate cuts, let's say we don't get 3 by December, what do you think is going to happen to TLT prices? They're going to fall, right? Because those yields will stay high, therefore TLT shares will fall. So it's a good question, but there is no definitive answer. If you believe we're going to see more and more rate cuts, that you think that's the pattern coming, then yes, you should buy a bond fund because you're going to see the appreciation of that bond fund in price as the yields decline. So great question. Long-term bonds, more sensitive to interest rates. I don't believe so. I think shorter term is going to be more sensitive, right? Because that's a direct impact to that short end yield curve. The market dictates really what the long end of the yield curve is. So, we could see a rate cut happen in the long end. The 10-year stays right where it's at and doesn't move. Well, that would need to happen a little bit more for us to get to a normal yield curve that looks like this. So here's a let's see if I can get this. It's always tough to do. This is a normal yield curve. That's where we should be, right? And notice what happened once we, all of a sudden the long end of the yield curve started running up because people were concerned about economic issues. And then all of a sudden we just flipped that and went full on inverted. Oh man, that's just such an ugly inversion. So yields are really high right now and the short end's flipped. If we go back a little bit, right here, what was it? This was August of 2022. We were a flat yield curve. It says inverted, but it's fairly flat. We have to go back to something like January of 2022 before we see a normal yield curve again. So, typically what happens, you get an inverted yield curve like this, and the market's going to rally up for a little bit, and then they fall apart. It happened back here as well. You had an inverted yield curve, and this is, I say back here for the podcasters, this is 2020. You had an inverted yield curve in April of 2020, and all of a sudden the markets took a massive dive. Fast forward into 2006, 2007, we went to an inverted yield curve right around, it went inverted for 1 month, I think. There it was. It inverted in late 2006, and all of a sudden in 2007, we just cratered. And now all of a sudden we are at this inverted yield curve for quite some time. So I am a believer that an inverted yield curve leads to a recessionary period, and we've been inverted for quite some time. It's the longest inversion of the yield curve in my lifetime. So if you see a recession coming, buy it. I would let the recession come and then buy in that recession, not buy before you see a recession coming, because then things slow down and you're going to lose a ton of money. I would make sure that if you feel like a recession is coming, you have ammo. You got money in the pocket to buy things you want, whether that's real estate. You talk to all the people that have had the greatest appreciation in the last 15 years. because they bought in 2009. And the market's just gone haywire ever since. That was a pain point. The market was just falling apart. And if you had money back then, you could have bought in 2008, maybe 2009, and got a great deal in a home. You could have bought the equity markets. Again, should have, could have, would have. When we see another situation like these, where it really has a tremendous sell-off, that's just opportunity for you and me. So I'm looking forward to them. Cool. All right. Well, I think I got that covered. Let's go look at your earnings calendar for mañana, because that's the last tale of the week right here. And you have Schlumberger, American Express, Halliburton. You have Regions Financial, tiny little guy there. The Travelers companies, and keep in mind, insurance companies have been doing rather well. Remember, that was one of the biggest year-over-year increases in the CPI data was auto insurance, I believe. Yeah, I think it was auto insurance, if I'm not mistaken. I know it was some insurance. It was 19% gain for one specific insurance product, and a lot of insurance companies may be reaping the reward from that. All right, that's going to do it. I'm done. Tired. Hope you enjoyed. Hope you learned something. Tomorrow we're going to do whatever you guys want to talk about. This show today was driven off of headlines and a question from Brad. So Brad, thank you on that IYR shooting star. I'll give it a 6.5, 7. I'll keep my eye on it tomorrow. If I can get around to trading that one, I have an alert set for it right now. We'll see. And maybe there's some opportunity for IYR as a short tomorrow. But again, I'll be covering whatever you guys want me to cover. So email me at TraderMerlin@gmail.com or comment down below any of the YouTube videos. For those of you who are new, hit that subscribe button. Thank you so much. I will see you guys tomorrow.